Welcome to the Foundation for the Study of Cycles. Today is a special episode. We have a special guest today. Peter Eliades will be with us today, and I'm very happy that he agreed to join today to discuss his method approaching cycles. And especially we have a special situation on the markets right now where we also analyzed our time cycles and his special publication he did in November. So I'm very happy that we can have some time to discuss his analysis and methods. So, Peter, nice to have you here today. Thanks for taking the time with us. I'm very honored to have you on the show as this, what I would call rock star regarding market analysis, cycle analysis. I mean, I think you started 1970 something when I was just a baby with your first analysis. And I mean, since then you have received all the honors from the Market Technical Association, the Charles Doe Award. I think your active money management career was honored by first ranking in Timers Digest during the 80s and 90s. So you have proven that cycles works and you can apply it to real markets. So therefore, I'm really honored that you take the time with us and the foundation today. So welcome, Peter.
Thank you very much, Lars. It's an honor to be here with you. I've supported the foundation as long as I've been aware of it, and I think they do wonderful work. It's been through a few cycles of its own, as you know, but it's nice to see you and people like you that are there now doing things that they're dedicated to in terms of the study of cycles. I guess particularly in respect to the market, because that's the aspect that most people find interest in, because they think there's money there, and wherever there's money, there's a greater interest. But just the study of cycles itself, yeah. I think most of us that study cycles can say that that's our theory of life,
That's the purpose, and I'm really honored to be part of the foundation now, to try find a way to revibrate the energy and the knowledge on cycles. And I mean, markets, we have lots of data where we can apply this analysis. I mean, that's also what I like on the stock markets. On the other hand, that we have lots of data, being it minute, daily, weekly, long-term series, so it can't be better.
We are so fortunate, Lars. You don't know how fortunate you are, because you're a little kid compared to me. But when I first started studying cycles, I would take the Mansfield charts, which were daily and weekly charts. We're talking now around the very late 60s, early to mid 70s. And I would sit there and count 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and make a little mark. And 1, 2, 3, 4, 5, 6, 7, 8. I mean, it's just incredible the progress that's been made in terms of how we get to analyze the market now and all the tools that we have.
Yeah, and I think that's the next area of cycle analysis. I mean, you have also been inspired by Hurst and his analysis. I can't imagine how he has researched, and you have researched in the early days, just looking on paper and drawing the cycle analysis on a chart with the first, I don't know, 1970 something. Have you used computers in the early days? No.
Not in the 70s, no. Yeah. That came, I got very early into the computer part of it, but that was not until the 80s. My first experience with computers was someone used to watch me on Channel 22 in Los Angeles that worked for, I don't even remember which computer company it was now, but he called me up one day at the TV station. He said, "Now you're talking about this cycle or this indicator. If you'd like," he said, "we can program that on our mainline computer." And I said, "Whoa, yeah, I would love that." So that's when I first really started connecting the data that I had with what was happening in the market, and it was very exciting at the time.
Yeah, and that's the purpose, what I'm trying to also now propel into the foundation, that all the digital signal processing and algorithms, but however, the knowledge from Hurst and your work is still important, because otherwise we would not know what to do with all this digital signal processing. I think we need to understand the knowledge, the experience, what you have gathered over 40, 50 years now with applying these methods. Computer alone would not help us here. So
that's true.
Yeah, and therefore maybe the session for today, let's maybe set up a shorter agenda even for our viewers here for today. So the main reason I reached out to you was you did a major public video based on your analysis in mid-November, and that was partially the exact same time we analyzed some time cycles here at the foundation with the digital signal processing. And we had some major time cycles, long-term time cycles, weekly cycles, which seemed to get into alignment end of October, beginning of November. And just as we analyzed these cycles, you published, or I saw the publication of your work, which also had a very interesting current actual situation. And I think that's one topic to get into it and maybe discuss it also then later on. But maybe before sharing this analysis, before getting into your method, how have you evolved since Hearst? I think you took the basic idea of Hearst and then developed that into your extended method. Maybe you can share some.
Yeah, the basic way that I'm not saying that I improved upon Hearst, but what I tried to do was, especially with daily charts, to be able to work with daily charts without having to completely redo them and reconstitute them with calendar days on them. Because the original Hearst work used calendar days. They used Saturdays, Sundays, and holidays. They left a space for them. Well, it got very frustrating for me because especially at the early days of computers, there was no way to draw a chart and have a Saturday and a Sunday space or a holiday space in there. So I wondered how big a difference it would make if I could interpolate all those things into a regular 5 trading day chart rather than a calendar day chart. And that was a big part of my work in terms of reformulating the Hearst offsets and the numbers that were used to interpret these cycle projections. So that was a big part of what I did. And it wasn't any great original genius work. It was just practical, down-to-earth work that appeared to work. And, people would say, well, now, wait a minute, you can't do that because you're treating the 5 weekdays as if they're more important than the 2 empty days that aren't there. And I said, hey, all I know is that it works. That's the bottom line. And so if it works, I'm happy with it.
Yeah. And I think that's a common topic we need to deal every day. So should we use calendar days or should we use just trading days, even if we apply our digital signal processing? So it's always important. Cycles don't stop at weekends or even, we don't know the root cause for the cycles alone, but maybe if there's something behind these forces, they would not stop on Fridays and restart on Mondays.
Yeah, of course, in a way, you can avoid all that by simply using weekly charts.
That's
but
right.
I wanted to do more micro work. In fact, I took it to the point where I not only do daily charts, but I also interpolate those into intraday charts. I do 27-minute future charts and 30-minute cash charts, 45-minute Globex charts that are 24 hours of trading. So I try to bring all those things together and determine what the offsets would be, the half spans for the cycles in those elements. And that's one of the things that my computer program does.
Yeah, nice. So, you mentioned you have prepared a little bit in introduction or some basic guidelines. So if you want to start, or feel free to share some principles.
Yes, I'd like to do that. I'll share my screen and show a few things. Let's go through this. I won't take too much time with this, and I think a lot of people are acquainted with it. But this looks like a typical stock chart, I would argue. You have a support line here. You've got your descending tops line. You break that and start to the upside. You've got a little triangle formation here. When you break out of it, you have a big rally to the upside. What that ends up being, however, is simply a combination of sine waves and a straight line. And let me, I've got this animated so I can quickly show it. Hopefully it'll work. So here's where you see this is what I call the longer cycle. Now I don't mean by showing this to suggest that the stock market is as simple as this is, with 3 or 4 cycles in a straight line, but I want people to see how they combine and then how we analyze them. So there are 4 sine waves here, okay? And then for fundamentals, they could be either up or down or sideways. I use a straight line. If you add all of those together, you get this green line that's forming now. And of course, that green line turns out to be exactly this chart that we showed here. So here is it again with all the combinations. There are 4 sine waves, a straight line representing fundamentals, and the resulting lines that we see here, or a line that we see, is a chart of the stock market or a individual stock. So from that, I want to go quickly into the theory behind projections. If you have a 20-week cycle and you do an offset, so you take the top of your cycle and move it over 10 weeks, which is what this dotted line represents, then in theory at least, this dotted line that is brought forward 1/2 the span of the cycle should cross the sine wave or the line, the cycle line, at the exact midpoint, okay? So if that is the midpoint, then let me go to the next chart and show this. This is more like a stock chart, although this is idealized also. So let's say you have a chart, we have a top here at 21, and here's the offset. If this is, we'll say it's a 20-week cycle, and 10-week offset, which is the dashed line, crosses exactly at the halfway mark, okay? So our task, if you will, as analysts, is to find which cycles give us the correct forecasts in the market. We start out with the shorter ones and then go to the longer ones. Once you get a projection in the shorter offsets, then you go to the next longer one and say, did the meeting of that, for example, this is a 10-week offset. When we get down to this price here and beat the projection, then we go out, excuse me, then we go out to the next longer offset, which in this case would be 20 weeks, and see if the low that we just reached crosses below the next longer offset. Mm-hmm. Once you get a point where all projections have been met with no further offsets giving projections, then you should theoretically be at a turning point. So I'm going to stop sharing the screen now, and we can talk again.
I think you're using the nominal Hearst model, right? So the 5 days, 10 days, 20 days, 10 week, 20 weeks, 40 weeks, and so forth. So I mean, the nominal model does not mean that there must be the exact 20 or 10 week cycle, but this is how you set your offsets, right? So
that's correct. That's correct.
Yeah.
Yeah. And see, what I had to do with the daily charts is, for example, a nominal 10-day projection, if you used calendar day charts, you would offset it 5 days.
For the trading days.
Half span of the cycle, okay? So now when I did my translation to market day or trading day charts, I had to figure out which was the correct offset to use. And what I did, after a lot of calculations, is come up with a number of 3.5 to 4. So a 3.5 to 4 day offset would be the equivalent of a 5-day calendar day offset.
For a 10-day nominal cycle, right?
For a nominal 10-day cycle. For a nominal 20-day cycle, it would be 7 to 8 trading day offset. For a 5-week cycle, it would be 12.1 to 13.8 trading days. And I went through the whole sequence like that. And when I show you a little bit of the cycle projection software, you'll get to see how that comes together.
Yeah. So you're not, or how do you determine if the 20-day cycle is active or not in the market? So I think
my assumption is that it's always active. Okay.
So always.
There are times when a cycle will be invalidated, and that the great thing to me about the cycle projections is you don't sit there like a dummy waiting to say, no, I know my projection's going to be met. If you have a crossing of the lines that we showed, and you get a projection, but then a few days later you get a crossing back in the opposite direction, that downside or upside projection has been invalidated.
Yeah.
So there are times when they won't work. And in fact, that's part of my statistical package, or part of my projection package does a statistical study. When you put on an offset over a certain period of time, whether it be 1 year, 2 years, 5 years or more, you can put the offset on and ask the computer, how many times was this offset successful? How many times was this projection met? And as a general rule, I have discovered that usually works to the low 70% all the way up to 80, and sometimes even more than that. So that's pretty good percentages for success of projections, I think.
Yeah, no, I think that's the interesting point from this model, because I think when watching your analysis, when the offset line you generate with your offset then is crossed by the signal line, this is the point where you say now the cycle is active, or the signal becomes active, right? Because otherwise you would say, okay, the cycle might not be active or might not be useful for doing price projections. But once this is crossed, and as you've shown on your chart just before, then this is what I would call you say, okay, this cycle is now validated and active, and now I do my price projection.
That's correct. And let me give you an example. For the 3.5 to 4 day offset, there'll be times when on the computer I put in both those offsets, 3.5 to 4. The space in between them I call a continuum. Mm-hmm. So that continuum is actually, I have a great programmer who put this all together, and I'll show you some charts where we have the continuum actually programmed where you can visually look at it. When we first get a crossing into the continuum, I call that a preliminary projection. It needs to be confirmed by a crossing with all aspects between whatever it's for 3.5 to 4 days. You need to have crossed above or below any of those periods, 3.5 to 4 days. So you need to get above for an upside or below for a downside, the complete continuum, in order to confirm the projection.
This is what I wanted to ask anyhow. So I think, isn't it so that in the original Hurst model, he used one offset line, and you are using more or less two, so a minimum and a maximum for each nominal cycle model? This is also something you advanced in regards to the classical Hurst model?
I did that as part of trying to adapt the daily projections with trading days into what would now become market day charts rather than calendar day charts. See, Hurst would use a 5-day offset, calendar days, 10-day offset, calendar days. And I said, well, wait a minute. I need to use market days because that's much more practical. But when I started to do it, I said, well, 3.5 is really close and 4 is pretty close. So I said, why don't I use them both and just insist that they both get crossed? So the longer the cycle gets, the greater the distance between those two lines. For example, on a, let's say a 5-week offset, which is 35 calendar days, it would be 24.2 to 27.6 trading days. And we would have that continuum in between where you had to cross completely above or completely below the continuum. This will be a lot easier to understand when I show the software.
But maybe, so feel free to go into some details and then maybe discuss it afterwards again.
Sure. But that's part of why, you see, what Hurst did was have strict one-line offsets, but he'd allow for a 10% margin of error. So he would say, okay, it's a nominal 10-week cycle. We have a 5-week offset. So you would see where you cross that 5-week offset. Then you'd measure the distance from the prior low, if it's an upside projection, to the projected high, and take 10% of that as an error possibility. So if the prior low was 10 and you have a projection up to 20, that would be 10 points. So you'd say plus or minus 1 point.
Yeah. So how do you want to start with an example? Can we have a look at the November analysis
Yeah,
you did?
I have that set up. So we'll take a look at what things
Great.
looked like in November and why I did the things that I did. Let me go back to my screen again. Okay, here we are, and this date, I set it up, so the last date would be November 16th of 21. That's the date I did the update that I think you saw, okay? So the current offset on here now is 24.2 to 27.6. That's the equivalent of a 5-week offset for a nominal 10-week projection. Now, these are ugly, squiggly lines, but it's because I finally found a programmer who could do exact offsets. Mm-hmm. You know, usually they'd want, no, I can't do 24.2 or 27.6. And this guy said, yeah, sure, I can do that. And he did. And that's why they look funny up here, because it's exactly 24.2 and exactly 27.6. But what he did besides that to make it easier to visualize was we have what we call a web chart that makes the continuum. So before I show you the continuum, let me show you what you're going to see. See this red line right up here that has a little tail to it? Okay, if you can visualize that, that's 24.2 days from back here where you use. And by the way, I don't know if I even explained, but all these offset lines are the midpoints of each one of these bars. The median of each high-low bar is what we move forward in time as an offset. So this bar, this red line right here, is moved forward in time 24.2 days from this area right in here, okay? So if you can picture me moving this forward ever so slowly in a continual basis until the red line gets to the blue line, that's the continuum that I'm talking about.
Yeah.
It would be very difficult to do that visually and try and make projections. So what the programmer did was this. We said, show the web chart. And with the web chart, I'll zoom in here a little bit. Here's the continuum, okay? That's as if you took the 24.2 and moved it slowly over to the 27.6. And we have what I call the continuum that once we get above or below, generates a projection. So, and the signal line is simply the midpoint in real time of each bar.
Yeah.
So as you can see, right here, we came very close. Here we entered the continuum. So we immediately got a preliminary upside projection, probably up into this area somewhere here. On the very next bar, it doesn't always happen that way, but on the very next bar, we got completely above the continuum. So this upside projection was generated.
Yeah. So Peter, what you're telling is, so if you use you use two offsets. The first one is the 25.2.
No, 24.2.
24.2, and the other one was the 27, I think, 0.6, right?
Correct.
So, and this is the minimum and maximum you use, which then, if you shift these two offsets and then you connect the two lines, which is here the blue shaped black round, no? Between these two offsets. And this is the 10-week nominal cycle, right?
Nominal 10-week cycle, that's correct.
Yeah,
with the equivalent of 5-week offsets.
Correct. So half span of the nominal cycle. Yeah.
Right.
Okay.
So once this bar appeared that was completely above the continuum, the computer would immediately put up this green box. And that green box tells you that I'm measuring from the lowest entry into the continuum to the highest exit from the continuum. So this whole period in here encompasses an area that could be called the half distance of the projection. And so once that is known, you come outside the continuum, then you know this is the area. They're not always this big, but it depends how big the continuum is that you go through. If you cross the continuum, let's say right here at this very narrow section, then this box would be a lot thinner. But this was the projection box, and all I do is have to click my arrow there, and it says upside projection. The start of it is 46.52.42, and the end of it is 47.29.85 up here. Okay, so now let's go back to, is there any question you have on this chart?
Just to clarify, so the lower and upper level of the projection is related to the size of the continuum, right? So
it's that's correct, where you enter and exit the continuum and any space in between.
So this defines the minimum and maximum projection. But the price target in general, I think this is related to the last major low, or the distance of the low until you enter the continuum to set the price target in general.
Yes, if you measured this low back here,
yes.
If you measured from that low to this point right here where the continuum was entered, that would give you the lower end of this projection box.
Right. Okay.
If you come through it to the top, the highest point is right here, and if you measure from this low to this highest point, it will give you the upper end of the projection box.
Yeah. Yes. Thank you. Just for clarifying.
Okay. So now we'll get rid of this and go back to the chart. Okay, let me make a few little adjustments here. Make the spacing bigger so we can see them. Okay, now this is interesting, okay? This is what happened. When we got up here, for me, that's a market top. There were no other. For example, let me show you the next longer offset, which is 48.4. We never got below it. Now you can say, well, wait a minute, there's a couple of bars here that were below both lines. Well, let me show you the continuum. That's the answer. Because remember, we're taking this red line and moving it slowly over to the blue line. And so you can see there's a little V-shaped thing here that we didn't get below. Let me show it to you. It's always so much more clear on the web chart.
Yeah.
See what happened here?
Oh,
we entered the continuum to the downside, gave a preliminary projection measuring from this high to this entry point, but we never got below to confirm the downside projection. Okay.
So does this mean, because we're always looking to ways to validate or invalidate cycle projections. So by this, the cycle projection was not validated, so it was invalidated. So with preliminary, you just say, okay, you have been on alert, or this cycle could become active, but as it has not broken below the second offset, this cycle, or the words I use now, the cycle has not been validated, and therefore no projection was done in regards to the price.
That's correct. Now, I showed you that because I want to show you that. Let me go back. In fact, I'll go to even the next longer offset, and you see we didn't come anywhere near. You can see that all these, we have there's no place for prices to cross to give us higher projections. That 24.2 came about because when we reached this point in September 2nd of this year, I thought that could have been an important top. But then we had this decline. Once you have a decline from a top, you're setting up more offsets for the future, okay? And so what happened was when we moved this forward in time, which is what you saw when we went to the 24.2 to 27.6, we got below it, and that sets up offsets for a higher projection. Well, that happens on both an intermediate to longer term and also a shorter term. So look what happened here. We reached this projection virtually perfectly. If you go across here, extend the box, here it is. We came right into the projection window. So imagine that was very useful because back here is where we got it confirmed. Back here, we had a confirmed projection up to the green window here. Okay, so let's go forward in time now and take a look at where we were. Once we got here, once we got to this high on November 5th, we had a little tiny movement down, okay? But again, that movement down set up the very shortest term offsets. See my offset box down here? Yes. These are the accepted, for me, these are the accepted offsets for a daily chart. The shortest one being 175 to 2. But let's take a look at both of those now and see what happened at this short-term decline. So here's the 175 to 2, and I'm going to zoom in on that. And as you can see, once we came down and got back up again, we got an upside projection. And here it was. That was met on this bar here. Once that is met, we want to go to the next longer offset, 3.5 to 4, and look at this. So now we're being told that no, this was not the top, because there are some short-term cycles that are generating moves that are higher to the upside. So this is the projection I gave on my November 16th update, on this day right here, November 16th, when I said, okay, this should be, it has the capacity to be a final high. Because if we go to the next longer offset, you can argue, well, can't you get, how about the next longer one? You can see that, no, we did not, we never got below it to generate higher projections. So the one that's important to us is this 3.5 to 4 day offset that gave this upside projection. And I said at the time that this could be one of the more important updates that I've ever done, because we reached all these upsides longer term, and now we're getting these little shorter term, I call them loops. We get a little loop down and back up through that offset. And here's the projection right here, calling for 47.32 to 47.42 rounded off, okay? Now, I'm going to try and quickly transition to, well, actually, I don't have to do that, because I have another chart I can show you that's in real time, and we can see how this resolved and what else has happened since then.
But please wait a second before we update to the current day. So this projection is based on a short-term cycle. So the 3.5 to 4 offset is the 10-day nominal cycle.
Nominal 10-day projection, correct.
Yeah. So, but the reason why you label this as a very important top is because you said, because also the longer cycles, which you have shown before, projections have been met. So is this a kind of an cycle price alignment between your longer projections and now the short-term cycle projection, right? Which come into alignment and would all have been met. So what you said before. So if all cycle price projections have been met on all nominal cycle models, then this is what makes you confident this could become a major cycle price turning point.
That's correct. But okay. What can happen almost ad infinitum, although I'll explain in a second why not, it should not happen. What could happen ad infinitum is we get up to here and then have another little decline that sets up offsets and then start getting above into that. And then down another one, little loops to add, where I say the ad infinitum. The reason that should not happen, at least in theory, is that the longer term cycles have topped. And while these little loops are taking place, I say that not because I'm working with the time element of it, but we have no higher projections from the longer term cycles. So they have topped out. These extra little additions we're getting are from shorter term cycles. If we went back and looked at that PowerPoint chart again, you'd see that you don't always top out price-wise where a long-term cycle tops out. Or you don't always bottom out where a long-term bottom comes in.
Sure.
There are shorter-term cycles that are working that could add a little bit more to the upside or add a little bit more to the downside on a downside projection. Okay?
Yeah. And I think this would become later on maybe interesting, because if you combine time-based cycle projection with price-based cycle projection, this could become even more interesting, because that's the reason why I said, okay, now we need to talk, because our long-term cycle projection get in alignment with the price projection. But please continue. So that was exactly the point. I said, okay, let's talk. But if you can update it even more.
Sure. Let's go to the. Well, I've got a different thing on here. Let me go to $SPX.X. Okay, now I'm going to show you. Here's the real-time chart now. Okay, and let's move it over and zoom in a little bit on it so we can see what's happened since then. I should have asked you to write down what that upside projection was that we got. Well, actually, we don't have to. We can do it again right here. We can reformulate it. I just wanted to show what I was looking at on November 16th when I saw that, okay? And here we are. This was November 16th right here.
Yeah.
See, there's a vertical area that I'm in.
Yeah.
So that's the chart I just showed you.
Yes.
And we got this upside projection that's in the green box here. Let me zoom in on that so we can see it more closely.
Yeah, I think it was spot on. So, yeah.
So just to show you how accurate these projections can be, the upper side of this box was 47.42 rounded off, and the high for that day was 47.43 and change.
Yeah,
within 2 points of a pinpoint projection. Usually the shorter ones tend to be more accurate because you're working with shorter term cycles. The longer ones have a little more flexibility to them. But I mean, look how exacting this was, okay?
Yeah, it's unbelievable, yeah.
So now, from there, once you reach that and you think, well, this could well be a really important top, then you start getting the downside projections. You look at those and see. Now, what's happened recently is, I'll show you, the questionable one was the 24.2 to 27.6. Here's what happened. We got downside projections and met them almost perfectly, but we also, by the very narrowest of margins on the S&P, came down below both the offset lines, it looks like. Let me show you this on the web chart, which gives a lot better picture of it. So here's the high up here.
Yes.
Here's the date of the 16th right back here where we got this projection and met it. And look what happened here. We came down, didn't get below the lower end of the continuum. On this one day, we did do that. Except that very quickly, and I might add, the NDX, which is the other main index I work with, the NASDAQ 100, because it represents the hot group of stocks, never did confirm this. I'm going to show that to you so you can see that what you almost need to insist upon getting uniformity in projections, especially from important indexes. So this one indeed did confirm this downside projection just by a narrow little margin, and the very next day started calling it into question by going back inside the continuum from underneath, and the day after that giving this upside projection, okay?
But please wait a second. So what you're telling us is that by the downside move and as it has broken below the continuum, this cycle was validated and generated this downside projection, which is currently this gray box because it was invalidated just the other day, right?
That's correct.
Yeah. Okay. So, and you would have known by the next day that the cycle and the cycle projection has been invalidated.
Well, no, it wasn't invalidated here. It was called into question here because you've gotten back inside the continuum. When you get a downside projection, you want to remain below the continuum. But when it got invalidated, you had to get outside the box to the upside.
Okay.
So you might call it a validation of the invalidation without getting too complicated. But this is what invalidated this downside projection this day right here. And this was a huge up day, as you know, and a big gap to the upside, okay?
Yeah, but we have confirmed it already, right? No, there's still room to go higher.
But what I want to show you is the NDX. So we can see that how close. It's amazing how you say, well, wait a minute, the cycles know what's going on here because they didn't. Here comes the NDX, hopefully. Now, here's the 24.2. Let me confirm that. There's a 24.2 offset on the NDX. And look what happened here. Let's look at the continuum on this. See the difference here?
It has not generated a downside projection.
And this down move, and I was waiting, and I told my subscribers, I said, we do not yet have a confirmation of that downside from the NDX, and we never got it. What we did was we came into the continuum, did not get below it, and then had this huge move up again up to here, which is where we stand. Now, this only has, the web chart only goes through yesterday's action, so it doesn't have today in here. But now what we're looking for is, do we have a possibility that we're at a high already? And so what we start to do at that point is look at the projections from the shorter term. Now, I think, actually, let me go back to the S&P again, because that's more interesting at this juncture. Okay, look at what happened with the S&P here. Let's see if I'm going to zoom in and... Okay, so we came down, did confirm barely this downside with the S&P, but it was not confirmed by the NDX, and then we started up again. Well, the question is, can we give justification for being in a topping area here? And the answer is, when you got the invalidation of this downside with a 5-week offset equivalent, you got a projection to the upside from getting back from below the complete offset continuum to above it and giving this upside projection, which called for 46.41 to 47.27. Now, we still have a problem with calling this a top because we have to look at the shorter offsets, okay? So let's go through them. Let's look at the 175 to 2. That one gave a projection up to here. We've certainly met that. It's the 3.5 to 4 that is a little troublesome. No, not on the end. That's not true on the S&P. I think that's the NDX. But you can see here that we almost perfectly met this upside projection. Again, the 3.5 to 4, which is the equivalent of a 5 calendar day, nominal 10-day projection. The upper end of that window is 4,700.40, and the high so far has been 47.05. So for all practical purposes, we met this one.
Yeah.
The questionable ones, let's keep going out here because that's important. See, this one, we definitely have given this upside projection. Now, we need to see significant weakness very quickly in order to invalidate it, but here's the upside projection right here to new highs again. So I have to tell you, frankly, I'm getting sick and tired of these little loops, that we have where we get a little decline that's maybe a few percent, 3 or 4 days, and they come down, and that decline sets up the offsets that allow for higher projections. So that's where we stand.
Thanks, Peter. That's great. Stay on this chart for a moment. So what you're telling the shorter term cycles are looping. I think that's the phrase you're using, which now shows up little higher projections on a short term cycle point of view. And we need to wait, or this at least shows there's some room until 5,800 on the SPX. What you would look for, or quickly fall below the both offset lines or the continuum. But do we need to reach this level before we fall down? So do we need, or do we must approach the target range and then, or can we also break below the 2 offset lines without touching the target area?
At this point, there are only 2 alternatives. Either the projection is met or invalidated. So if it's met, here are the numbers. If it's met, you go up to 47.85 to 48.43 rounded off. So that's the way to meet it. The way to invalidate it, and it's not that difficult, but you need to start coming down very quickly and get below these offset lines.
And and what you showed before is that you are looking, or the best projection would be if 2 markets, for example, the NDX and the SPX, on both markets, you see a break below both bands. That's more a cross validation, that you just not only use one market. So it would be a more stronger signal if both offsets or nominal cycle offsets would have broken on two different asset classes, or the tech index and the global index in general, right?
That's correct. We would like to see them agree with each other in terms of doesn't have to be exact percentage projections, but we want to see an agreement when the 24-2 offset is penetrated to the downside or the upside. We want there to be an agreement in order to be confident about the projection.
Yeah. Thanks, Peter, for sharing your latest analysis here. Anyway,
Sure.
Thank you. If you have some time, maybe let's discuss a little bit the reasoning or something behind this analysis, if you allow.
Sure.
Yeah.
We can discuss anything you'd like.
The work which we are using on the weekly series here each Monday is based on time cycle analysis, and your work is mainly based on price cycle targets. So do you combine or do you have another view on time-based cycle analysis instead of, or in addition to, price cycle analysis?
I still work with time cycles, but they've let me down so many times in the past that I far prefer the confidence of using the price projections. Because I know quickly if they're invalidated. They're going to tell me they've been invalidated. Usually quickly. If it's a really long cycle, it could take longer to unfold. If it's not going to work, it could take longer to tell you that. But that's not to say that I've disavowed time cycles. No, that's not true at all.
One topic I wanted to discuss with you also is, and the reason I get in contact with you, because we did some time cycle analysis back in October, which also did an interesting outlook. And if you have some time, I would be very happy to review these charts together with you.
I'd love to see those charts, Lars. I would.
This cycle analysis you can see here on the screen is an analysis we did back in October on our live YouTube channel. And what you see here down below, and I can switch to the live analysis in a second, is a composite cycle based on 3 dominant cycles, which are shown here. So and these are weekly cycles, so very long-term cycles. So the first one is based on 381 weeks. The second cycle is based on 186 weeks, and the third cycle is based on 143 weeks. And
I'm going to interrupt you for 1 second here, Lars, because I'm fascinated by the 143 week one. When I first started doing my cycle analysis time-wise with only Mansfield charts and no computer help at all, there were 2 cycles that were very strong on I think I found it in the Dow Transportation Average, but one of them was 140, the other one was 143 weeks. So I'm fascinated by the fact you have that there.
Yeah. And let me show you how we discover them, because this is, I think, one of, or a different approach, what I call what is purely based on digital signal processing. So I will switch to that chart, because this is just a PowerPoint, but we did this here live. So this is the real-time analysis we did here. And if we just browse this composite here for a second together, you see that the analysis started in 1998 here, right? And this is the composite based on these 3 weekly cycles. You see how nice these 3 cycles have been aligned just in this period. I mean, this is more than 20 years ago, up to 2009. And if we then browse forward here into this period here, then from 2008, then this low here, then these little whips, and then going up into 2015. And you see the correlation score, by the way, here. So this is what is then shown by this cycle model builder. Here's a very high correlation between the 3 cycles and the price action. And if we move now to the current situation here from 2016 now to the current situation, which we have analyzed here in October, you see the high correlation scores. So even if you go over these points in time here, and this is what we do with our time cycles, if I can show you here, I mean, we align here the top here with the top here, and the low, and moving up it's more sideways move than the major top here, aligned with these cycles. So that's the difference. Now we are not using the amplitude here and projecting any price regions. This is just used for pure timing. So therefore, we don't use the amplitude for price targets. It's really just finding the timing of these turns here on this chart.
What kind of amplitude do you attribute to each cycle? Does it change according to the length of the cycle, or?
Yeah, it's shown here. Oh, let me remove. It's shown here in the spectrum. So this is revealed by the digital signal processing approach, so a kind of Fourier analysis we are applying here to the market data. And here you see the periodogram or the spectrum of this analysis, and then here you see the amplitude is shown here on the y-axis here, and the length of the cycle is shown here at the x-axis. So that's, I think, the cycle with the length of, that's the peak with the cycle length of 143 weeks, and the amplitude shown here. So this is, or the largest cycle has the largest amplitude. Then this is the second important peak here with the 186 weeks. And then the 143 weeks. So that's the reason we pick these three cycles, because they are just purely identified by using digital signal processing. So this is nothing.
They're the ones with the highest amplitudes.
Yes, with the highest amplitude. And we use some other measures like the Bartle score here, which is more mathematical cross-validation from a scientific point of view. If we have a high Bartle score, then at least it's not by chance, so that we are sure that this cycle has repeated several times over the period. It's not a one-time cycle. But you're right. So we start with the highest amplitude and a clear peak in the spectrum. So that's why I picked these three cycles, and the Bartle score shows also good values here. And that's so the amplitude here is just an overlay, no? So therefore you can't use it for price projections here. Just for timing. But you see that every time these composite cycle reached these key points, we always saw these major tops in the markets. The only thing it was skipped maybe here, but this resulted in a 3 years of sideways moves from this top here. At least the uptrend was stopped at this point. And now we are exactly at this point today. So that's the reason I reached out to you, and that's what we did here as a cycle projection using the cycle analysis. And now you can zoom in, and it's still not confirmed. That's that's what I said. So, but it points to a very long-term downtrending main cycle now. So that's what I said. The long-term cycles, and I mean this it's kind of 8-year and 4-year cycle if you count the 300 something weeks and the 100 something weeks. So we're talking about an 8 years and 4 years cycle, which really seems to roll over now. I mean, you can't time this to the exact day, but we drilled down then also to some daily cycle analysis, and the daily analysis then showed us then this could be extended into November, December. I can plot the composite cycle also as an indicator below the analysis, right? So you don't see it as an overlay, you just see it below the chart. And that's the same then we put onto this PowerPoint here, where I then highlighted with the arrows the faces. And you see here from the red marked period that we are entering the next phase of the cycle here. So this would also point to a major market top, looking at the long-term time cycles here.
So the red periods mark the top of the combination cycles to the bottom of the combination.
Exactly. So if you see here in the year of 2000, that's where the top of this composite cycle, and then into the low period, that's the red marked areas, and the green marked areas is when the composite cycle is rising. So these are the periods marked here with the color coding. So that's what we're doing with our time cycle analysis. This is just showing that the long-term cycles are entering this next stage, projecting a longer, or the best case following this projection here is that we get a sideways moves for the next 2 to 3 years. Worst case is a downside move, which could be very, very sharp.
Yep. Interesting.
Yeah, that's what. By the way, that's what we also now pushed into the cloud. So what I've showed you as the application is what we on the foundation now hand over to every member. So every member of the foundation is able now to drill down into the cycle analysis, can change assets, change time periods, and you've seen that the spectrum chart just shows then which cycle is there.
Do you attempt to work with the spectrum things on a very short-term basis?
Yes, we do it also intraday. For example, here we have our dashboard where you can have a look at the major indices, and these are the daily cycles which are shown with current phase and current length, and then we can just jump to, for example, this is the daily chart of the S&P 500 right now. Yes, and now you see the spectrum of the daily cycles here. So this is now the current cycle spectrum of the S&P 500 with data from yesterday. And you see here there's a clear dominant cycle with a length of 170 days, but this is trading days. This is not calendar days.
Yep.
We also see these 3 picks here. We can activate them as a composite cycle and overlay. And here you see what the daily cycle would allow just some room for the top to take place into late December here. This is what I said. Yep. So we had the bottom here. So if I can show it here. So this bottom might be in alignment with this situation here. But now we need to see what this dominant cycle is looking for here. And we should also add the longer term cycle. So this is then now building the composite based on these 3 cycles here, where we can see that this might be, or we might wait for the second top here to come in.
Now that composite is how many cycles?
3 cycles.
3 cycles?
3 cycles, right. So
and these are all, are they theoretically the most important cycles
yes.
with the greatest magnitude right now?
Yeah, exactly. So because these 3 amplitudes they have the highest amplitude, which you see here in the spectrum, and they have a clear peak in the spectrum. So there are also shorter ones which we could use. So for example, the cycle with a length of 50 days, which is shown here, we could add this to the composite, which would then generate this outlook here. Or if we this would be if we just have a closer look to these 4 cycles now in the current situation, and you also see how nice they align to. But then this is the path which is projected here.
Yeah. Interesting.
Yeah. So needs a lot of research, but that's now what computers can add to this.
Oh yeah. Yeah, well, you and I will talk, Lars, and within the next 4 or 5 years, we will combine probably about 15 or 20 cycles and be able to predict the market every day.
Let's do that, Peter. Yeah, but to be honest, that's what I said. Let's cooperate here more on the foundation, because I think the combination of price cycle forecasting with time cycle forecasting and putting computers into the mix, cloud platform, it can't be easier than these days. I would be very happy if we can share a little bit the experience and maybe bring something forward.
Yeah, there are some, it's interesting. I'll tell you one more story about the cycles and the projections. The longest offset that I have been using typically has been a nominal 4-year projection offset of about 100 to 110 weeks. But in the decline from 2000, actually the 2007 top to the 2009 decline, it didn't fit in with any of my nominal cycles. And I said, what's to keep us? Let's go to the next longer offset, which would be double the 2-year, and let's go to a 4-year offset for a nominal 8-year cycle. And if you do that, it almost gives you a perfect projection in the 2009 bottom.
Yeah, That's interesting. And I think what on time cycles always impresses me, we can analyze sentiment data set like financial stress indices or volatility indices where we are not looking for price targets, where we're looking if these sentiment cycles confirm time-based projections. So if the financial stress index, which we could also do here with this application, just to show you, we have all the sentiment data sets like the volatility index or the financial stress index here from the St. Louis Federal Reserve Bank. And if you just open these data sets here, this is a weekly data set, so this is a weekly analysis. We can have a spectrum analysis on this data set and also can reveal important cycles here, but just based on digital signal processing, and apply these cycles then to discover. And this is important here. And just if you have a look at the historical cycle here, you see how clearly this cycle is in alignment with financial stress tops, and bottoms. So I mean, don't take too much attention to the absolute amplitude, but this top here, this low here, this top here.
Yep.
I mean, you see it, and this we are currently, and that's interesting here, at a major financial stress low. You see where the projection goes, and this is another confirmation time-wise, because a low in financial stress then also correlates to major market highs. So that's the interesting part here. So this also confirms, just looking at it's a completely different picture, 198 week cycle on the financial stress index, also pointing to a major financial stress low, which is similar to a major market high here. And that's what makes the time-based analysis of these data sets so interesting. If we see a cluster where different data sets from stress index, market data point to the same outcome, this is where the time cycles start to get interesting. If you see this combination, that's really fascinating.
It is fascinating, yeah. Well, good. I'm glad you got a chance to show me some of your confirming things. It was very interesting.
Thank you.
I appreciate that. I look at a whole range of different things with time cycles. I like to, George, have you heard of George Lindsay? I think if you've done any cycle work, you must have heard of him, because he was one of the past cycle masters. Lindsay looked for a pattern called bottom to top. That disturbed me initially, because I said, I don't want cycles to be bottom to top. I want them to be all bottoms or all tops, But when I started looking at some of his things, I could give you one or two of them offhand, but I don't have them offhand. So, but some very important turning points have occurred when you measure from a bottom to a bottom and then project that same time forward into a potentially important market top. So I started paying attention to that, and we have tools in our computers now where we can very easily if we think we could be at a top, then we simply have the computer mark that as a potential top and go back and see if there are bottom to bottom counts that would lead to that top in the future. So there are ways that computers have made it so much easier for us now to do that kind of analysis. So I still look at time cycles, and I have great respect for them.
Yeah, because I think that's maybe an area where it might be useful to pay attention to combine these both approaches, because that's what I said in the beginning. It's always easy to do a time cycle projection and to detect cycles, but it's hard to understand if this is a valid projection, or to understand when this projection might be invalidated. As you said, then maybe you will learn the hard way, which is not what we're looking for, what you mentioned. So your model helps and quickly identify also when something is invalidated, or even a projection is not given because it's not crossing below or above the offset lines. That's correct. So, and I mean, what already anyhow impresses me, you're using this model since 40 years, 30 years, so you still stick to it, or what have you improved or learned by using this?
You can go back to, I really, at this point, I've forgotten when I first started doing this offset method of getting projections. but it was at least back to the mid 70s, late 70s, early 80s, because I remember there was an article in Barron's right after the 82 bottom. And this was a real smart alecky type article about technical analysis and saying, oh, Joe Granville said this and he was so wrong and he did this. And I wrote them a letter, which they published. And I told them about the projections I had at that time and a few other things technically that almost perfectly picked that August of 1982 bottom.
Yeah.
And they published that letter, and it was great. I was so happy to see them publish it, because it was kind of saying, hey, don't be knocking technical analysis because you found a mistake by one technical analyst, Yeah. So it's always been an important part, but at least, so we're talking at least 40 years now that I've been doing these projections.
That's fascinating. So, and isn't it, Hearst called it, I think, the original, the future line of demarcation, right?
That's correct,
But I think you don't use this wording anymore. So
I never did use it, and I'm not saying I'm right, and I'm not saying it's a bad expression, because obviously it's worked for a lot of people. Some people still use what they call a future line of demarcation, but I simply call them offsets. Yeah. And I give them names, and I give them nominal cycle lengths.
Yeah, I think that's the important, or at least research or experience you added, so that the offsets are important, or the right offsets are important. So you need to understand that the nominal model is based on calendar days, and you've explained how to translate that, and you've also experienced translating this on, different markets use different continuous time frames, so you need to make sure that you adapt the offsets, and this is where you have extensive experience doing
it never ceases to amaze me how these projections work. We just showed you an example at the recent high, that when it caught that high to within a couple of points, it gets very frustrating when you meet all the upside projections, as I said, and you just start to come down a little bit from there, 2, 3, 4%, and turn around and get another projection. Yeah, there's no way to avoid that, and it frustrates me, and it frustrates my subscribers, because they say, didn't you say that could have been the final high? I said, well, yeah, that could have been is the operative phrase, because we never know. I guess what I have to be more careful with is, I just showed you what happened when we had that 24.2 to 27.6 offset, the equivalent of a 5-week offset, nominal 10-week projection, when we did not get confirmation by the NDX of that downside projection that came off that November high. Then at that point, you have to be careful. You have to say, hey, we're not getting a confirmation of the downside, so this thing could very easily turn up, because it has met other downside projections, and that gets quite frustrating. It really does.
Yeah. So the final top, according to this, is not confirmed. We can go in loops on the smaller cycles now, but nobody knows. We have the seasonal cycles and all the other activities which might influence this topic. But Peter, thank you. But when can we buy your book, Stock Market Cycle Analysis by Peter Eliades?
I'm probably beyond, even though I feel like I'm still in my mid 40s or 50s. I am 82 years old now, and I've been around for quite a while. Wow. And I don't know as we'll ever get to buy the book, but we can, the people that are interested in cycles, and they will be if they're watching this tape, can easily go to my website, StockMarketCycles.com, and we offer a 14-day free trial of not only the software, but the software plus my daily video commentary. So if you go to StockMarketCycles.com/register, and that'll take you to where we offer the free trials to both, either or. If you don't have the capacity or the will to use the software, which I think is fabulous software, thanks to Stefan Scheuermann, my German colleague who wrote the software for me. You can get either one or both for a free 14-day trial.
And I can just recommend everyone doing that, because the knowledge and the experience and the way to see on the charts is fascinating. So everyone interested in cycles should do that and reach out to that. And at some point in time, I still want to read a book on that. I mean, 40 years of knowledge. It's not only software, so it's not only about software. It's also about the knowledge, which is very important. But I mean, that you are still active and providing this knowledge even in your YouTube videos. You have also a YouTube channel, so I would recommend anyone also to follow Peter's YouTube channel, where you get from time to time some updates there. I would like a big thank you from all the cycle fans out there that you still stick to cycles. I mean, there are not much on this planet with this experience and this knowledge, and which have proven that it works in a way. So I'm really fascinated every time I see an update, and I'm one of the biggest follower. And I hope that at least everyone who's following the foundation needs to follow Peter anyway, and maybe we can get more collaboration between you and the foundation moving forward. This would be great.
Thank you, Lars. I appreciate your kind words. I really do.
Sure. Peter, I mean, we're running, I have thousands of questions, and it would be nice to talk to you, but I think for today it was great to have you here, see your current updates here live on the channel, and have a short chat on that. So I really thank you for taking the time with us today. Have a nice day, and I'm sure we will talk again sometime.
It was really a pleasure to talk to you, Lars, and you keep up your good work with the foundation too. We appreciate that.
Thank you, Peter.
Hello, I'm Dr. Richard Smith, the Chairman and Executive Director of the Foundation for the Study of Cycles. I hope you enjoyed our presentation. I'd like to ask that if you're not a member of the FSC, that you consider joining, so that we may continue to bring you high quality cycles analysis research and programs like this. If you're already a member, of course, thank you. Would you please consider making a donation to the FSC? We are a not-for-profit organization, and your donations and membership fees are tax deductible. Every dollar that we bring in goes to further the vision of our founder, Edward R. Dewey. Together, we can make a real difference and bring these critical reports and analyses to the next generation. Thank you for standing with the FSC, and see you next time.